Hi there. As you can see, Verizon is paying a nice dividend over 8%, almost 8.4%. And the stock price has declined by over 40% from its peak. And if you wonder if this dividend is sustainable, then this video is for you. So let's begin the analysis. First, you can see that the revenue is expected to decline a little from 146 billion to 143 billion, and then it is expected to increase a little. By 2027, the analysts expect the revenue to be around 148 billion. And their earnings are expected to decline this year from 21 billion to 19 billion, but their free cash flow is expected to increase from 14 billion to 17 billion. And then it is expected to grow a little bit in the future to 22 billion by 2026. And also their earnings. Even though it is expected this decline, they are expected to rebound from 19 billion to 21 billion by 2027. So it looks like this business is quite stable. You may expect 20 billion a year for the next 5 years. So that's great. Also their dividend is expected to increase a little from $2.58 to $2.79. That will be a dividend around 8.8% at the current stock price. So it looks good. Now if you look at the second quarter results, the revenue has declined a little year over year by 3.5%, and also their earnings. In the short term, they may report other declines. But overall, if you look at the whole picture, the revenue is expected to be stable. Quarter over quarter, they might report some declines. Now, what can go wrong with this business? Because you also have to focus on the risk. Well, the problem is their debt. Their total debt is about 152 billion. However, as they are making about 20 billion in earnings or free cash flow, that debt can be manageable if they don't increase it even more. Plus, also their dividend can be sustainable. As I said, they are making 20 billion free cash flow. 11 billion goes to shareholders. They pay this nice dividend, around 8%, and 9 billion is used for their repayment. So if they don't take on more debt, they can manage this risk. As I said, they are making 20 billion a year. But if they take on more debt, then it might become a problem. And if that happens, this dividend may be affected. Don't expect that they will cut the dividend. There is a low probability. But this dividend may be reduced. Be aware that this business requires a lot of money. They have expenditures, they have to invest in their infrastructure, new equipment every year. Plus they also have to buy their wireless licenses. A wireless license lasts around 10 years. And then it must be renewed. So this business requires a lot of capital. And if they don't manage well their costs and their debt, then their dividend may be reduced. This is the risk with this business. Moreover, you might also see some dilution. If they face other problems in the future, they will need more money to expand their business. Maybe they have to invest more in their infrastructure. Then Verizon may issue some shares. As it happened in 2014, the number of shares has increased from 2.8 billion to 4.2 billion. And that can happen again in the future, if they need more money for their business. And maybe you know, when a company issues more shares, the stock price goes down. That's called dilution. So you have to be aware of those risks. Future possible dilution and their huge debt, because this business requires a lot of capital. Of course, they also compete with other players, AT&T and T-Mobile, and in the short term you might see some declines in their numbers or improvements, as people are moving from one network to another. That happens all the time. So they may report a decline in their numbers, but overall it will improve. From what I've seen, Verizon has the highest internet speed, so this is an advantage for them. Now let's see the valuation. First, the risk. Based on the analyst estimates, and if their growth rate goes down, the fair value may be around 115 billion for a 10% annual return, or the fair value per share $27. So the risk is not that high. But be aware, if they reduce the dividend next year, and then that dividend will rebound in the following year, then you might have a decline in the short term and then a rebound. Maybe they'll need more money to invest in their infrastructure, and they can reduce the dividend in the short term, and then they may be able to increase it next year. So you have to be aware of that risk. And the stock price can go down even more. I don't expect that the dividend will be cut, but a decrease in it may happen if they need more money. So this is the risk. Now the upside, if they keep growing and the free cash flow improves a little, then the fair value may be almost 200 billion. And as you can see, the market cap now is around 142 billion. Or if you want the fair value per share, that will be $46. By the way, this valuation includes the dividend, that 8% a year. So this scenario is likely to happen. As I said, if they don't face other problems, then you can expect more than 10% a year, almost 20% a year. You have the dividend plus an improvement in their free cash flow. So that can happen. And the normal case, where they may grow a little, the fair value will be around 167 billion, or almost $40 per share. So the current stock price, Verizon, seems undervalued. Your return may be around 50% a year, if they deliver these estimates, about 21 billion in free cash flow over the next 5 years. But don't forget the risk. They're huge debt, and they may need more money in the future to invest in their infrastructure and also their wireless licenses. So the current stock price, Verizon, seems a good investment. Even though the price stays down for a longer time, you still get a nice dividend. And it's up to you if you like the risk, that huge debt, and this business. As I said, Verizon requires a lot of capital to operate this business, and they may need more money in the future. So if you have any questions, please let me know in the comments.